We have Feroze Azeez, who's the joint CEO of Anand Rathi Wealth, joining us. Feroze, good afternoon. So good to have you back. Today it's been a choppy session, but just 7 days into the month, we have already gained about 2% on an index level. Do you think the market is looking at a much more optimistic scenario now?
Lovisha, yes, like you rightly said, we just in the first week of this monthly session or monthly expiry, and I think market's done well. But yeah, the kind of volatility we generally see on expiry that's got amplified lately. But during the full month, I don't think the markets moved in any of the last monthly expiries in the quarter, April, May, and June. We ended all of them at close to 24,000 plus or minus 100 points. So have we broken out of that range? The answer is yes, point one. Point two, I think the result season is what something I would look forward to. But if you look at how Nifty weightages are, 38% is in financial services. The second heaviest sector is IT. I think these two sectors contribute 50%. They've not done too well, and still Nifty has been resilient. Somebody has to be very, very positive looking at 50% of Nifty getting rogered, and still Nifty has not fallen. Like those exaggerated predictions after the war of 15, 19,000, 17,000 on Nifty were things which I read on newspapers. And we had predicted about 7, 8, 10% fall, and that's what happened. And markets have reversed once the war subsides. Markets, more often than not, 11 out of 12 instances in this century, they've come back to the peak, which is 25,200 in our case. I would not be surprised from a long-term standpoint, like you alluded, in this financial year, markets retracing a new peak and expanding the canvas is a larger likelihood than people would envisage.
Okay, got it. But Feroze, you said that market, it's the scenario is more likely that the markets could see a new peak. Any particular timeline in your mind?
Yeah, I don't know about timelines because see what happens is we only go by probabilities. A long-term investor needs to ask only one or two questions. Most people get too engrossed in the event rather than the impact of the event. Like I met somebody in a lift in my house. He asked me what do you think of the war? I don't think investors should worry about the war. They should worry about the impact of the war. The impact of the war is more important than the war in itself. So I don't know about the timing, but I'm speaking about 90%, 80, 90% chances that this financial year a market might retrace those levels. Now, if it is 26,300 or 500, the return of the portfolio doesn't change too much other than creating a newer peak. So I would say that if you look at the Nifty earnings in rupee terms, which most people end up not tracking, they only look at the growth number. Rupee terms, Nifty closed last financial year, surprisingly to everyone, but Anand Rathi's prediction was 1186 rupees on Nifty. The closure was 1195. And people are not speaking enough about it. The earnings 10 years back, FY17, if I'm not wrong, FY16 was 330. And today we have 1195. The earnings growth for the last 10 years of Nifty companies is 12.95%, whereas Nifty's growth is 9.2%. So almost a 3.7% earnings have outperformed the price. So in situations like this, you can definitely over the next 3 years expect median plus returns. Median returns of Nifty are 11, mean returns are 14. I think outperforming the median is a very large likelihood for 3 years. Establishing a peak is a larger likelihood for this financial year, driven by these two sectors, financial services and IT, which are 50% of the weight of Nifty.
Okay, got it. But yes, we'll just be starting with the earnings in just a couple of days itself, Feroze. Any particular growth expectations, particularly from the June quarter across large, mid and small caps?
See, I personally think all four indices, which are what one should be very cleanly tracking. What are the why four indices? Nifty 50 you have to track, of course, because that's like our international team. If you send a team for World Cup, that's Nifty for us. Then you have three other indices which SEBI has mandated mutual funds to follow for the large, mid, and small category. Those are subsets of NSE 500, Nifty 100, NSE 500, 100, Nifty 100, 150 mid cap, 250 small cap. These are the four indices. I would not be surprised if all these indices delivered a 10% plus growth on the last year number on a constant constituent basis. Constant constituent basis, by which I mean constituents change every 6 months in NSE. In MSCI and FTSE, they change every 3 months. If you assume there are constant constituents as they stand today, I would assume all these four indices will deliver more than 10% growth on their EPS. And that's a good number for a year like this, where last 2 years the price hasn't moved much, but the earnings have moved. We have seen almost 14% earning growth for Nifty from 1070 to 1195. 14% EPS growth, and I don't see people talking about it. And the earnings in terms of profit of NSE 50 companies has reached close to 10 lakhs, 9.5 lakhs from 3 lakhs. 10 years back, 50 companies were earning 3 lakh crores. Now they're earning 9.5, 10 lakh crores. And that doesn't still form a headline. So I personally think long-term investors should look at this disparity between price and earnings. So coming back, all the four indices more than 10% growth in EPS is possible.
Okay, got it, got it. We have seen a recent cool-off in terms of the valuations. Do you think these earnings are going to support with the kind of valuations that we are trading at from 21 PE down to about 18x PE?
I think valuations have come to a zone which is very comfortable from where we see it. We calculate the fundamental price, approximate fundamental price, and then see what is the froth in the market. Today, we are in Nifty at a negative froth of almost about 8 to 10%. Negative froth, by which I mean if the value should have been X, and if the current price is Y, X minus Y is the negative or the positive froth. So we have a negative froth, point one. Point two, if this happens after an event, especially when events happen, a lot of frothy ownership goes out of the market, right? If you leave a cup of coffee for half an hour, the froth is gone. Similarly, if you leave a market languishing for a year and a half, all these short-term traders who are buying stocks on momentum or wanting to make money out of trading, they reduce in proportion with respect to long-term owners. So after an event, the volatility of Nifty has always dropped. So a drop in volatility, lesser resistance next 1-2 years is what one could call this market as. So valuations very comfortable, almost 1 sigma lower than the mean and the median of the past, especially the top four sectors, which is oil and gas, auto, FMCG, IT, and banking. All of them, all these 5-6 sectors trading at more than 1 sigma on valuations. Is quite a positive sentiment in my judgment. Not, of course, the hope is least is when the probabilities of bounce backs are highest.
Okay, got it, got it. Feroze, you pointed out about IT as well. Despite it trading at reasonable valuations, rather cheap valuations, everyone is skeptical of whether growth would return in a sector like this. What do you think? How should investors approach Indian IT at the current juncture, given that they still see that the next 2-3 years is going to be quite, it's going to be quite tough for them to prove that, they are back into their growth trajectory, and whether or not the monetization of AI has proved to be worthy?
So I think IT sector, the AI capex cycle has begun. Someone has to see it. That's definitely begun. The US tech spending has gone up and is expecting to improve, is expected to be improving. Margins will expand. So if you remember the last time I was on your show, I said that IT is bottoming out. Definitely, I would start accumulating. Of course, will the things be a smooth ride? The answer is no. Will the times be tough as well? So tougher shareholders will make the money during tough times. You can't expect beautiful times and expect to make money. You don't make money in great times. You have to buy things, be tough to buy things which are in tough times today. So if you're ready to take that high beta, I'd also highlighted that a low beta defensive sector is no more a low beta. It's going to be a high beta sector. Unlike its volatility in the past, pharma and IT used to be the conventional low beta or defensive sectors. At least IT no more remains a defensive. So tougher times, but tougher shareholders can make money if they are ready to weather almost a 1.7, 1.9 kind of a beta with Nifty.
Okay, got it, got it. But in terms of growth, what should they expect versus before the, after the COVID boom? Of course, we have seen a slowing growth rate when it comes to the IT sector. At this point of time, when even we'll see any kind of productivity gains which is coming from AI, at that point of time also, what kind of growth investors should chase from Indian IT companies?
See, we can't have, as an Indian capital market participant, I can't have my cake and eat it too. when you're looking at AI in the US, AI is still not making money. It's making headlines. It's making profits in terms of price. So I would be, if there is an AI capex cycle, I wouldn't be too positive about the EPS growth. But will it create enough optimism that Nifty IT can beat Nifty by 4 to 5% per annum for the next 3 years? The answer is yes. If your barometer of measurement of the IT's success depends on PAT growth, I think it will disappoint you.
Okay, got it, got it. Feroze, let's also talk about consumption. Early Q1 updates has been showing that be it your retail, discretionary, jewelry, all have stood out with strong top line numbers. How would you look at them? And of course, valuation wise, do you think that they're trading at attractive levels?
No, I would say I would be neutral, especially FMCG stocks in Nifty, which are about 4 or 5 of them in terms of heavyweights. I would be very neutral. The earnings are a little defensive. Valuations are a little very rich. Volume growth is not as much as it should be. Of course, a good monsoon is like a catalyst package from God, unlike the government. But if that were to happen, then maybe some rural demand recovery could help. But I think the rich valuations there doesn't make it my top sector in terms of a fundamental pick, especially when you have other sectors available at 1 or 2 sigma lower than their valuations historically traded at.
Okay, got it. Feroze, the one trend that changed since the last time we had a conversation is that FPIs have turned net buyers from the second half of the June. Do you think, is this trend sustainable? Because so far in the month of July also we have seen them buying a bit into the Indian equities. But the question is whether or not this trend is going to sustain going ahead. What are your thoughts?
I think largely those are rejigs. FIIs have a lot of money coming through passives, right? The largest portion of Indian Nifty ownership is driven from MSCI Emerging Market Index, where almost $2 trillion approximate wealth follows that index. And you see large Nifty companies underperforming not because they fundamentally deserve to be beaten down. If you look at banks, their credit growth is good, their asset quality has become better, but valuations are cheap. Now, you can attribute some banks had some compliance issue, but I don't think those were the large reasons. Those made headlines. What was taking away the wealth was Korea, China, and Japan, Taiwan were taking away a large portion of the weight. And that's why you would see large Nifty banks being sold to buy a semiconductor company. As long as once the unwinding cycle of a Kospi starts, then India starts getting a lion's share of the allocation of the passive funds, which was not happening. If you see a Kospi going from 3,500 to 9,500 back to 7,600, that's one of the core reasons why you see FIIs coming back. So will it sustain? That's the million-dollar question. It will sustain as long as the unwinding cycle sustains. So if Kospi has to reverse back, I personally think 1.5 years later, people forget Kospi's current rally and there will be normalcy. If that were to happen, a large portion of money needs to come back to India, but it will trickle. And of course, there could be some more signs changing from positive to negative before it becomes decisive as a trend.
Okay, got it. But today we also saw the SK Hynix launching its $28 billion US listing. What do you think of this particular news development and how do you think it's going to impact us?
See, it's going to impact us positively, in my judgment. Why? Because if there is a US fund manager able to participate outside the emerging market index directly in the US listing, then it'll actually free up more money for India in the emerging market index. Is my judgment. Of course, the impact is not going to be so positive or negative, but that's the second derivative impact, which is possible. And that will be my guess, just at best an informed guess, not a research report.
Okay, got it. Everyone has been saying that global diversification is a key to beat a volatile market like this. How much of a portion should investors should diversify globally at the current juncture? What is your suggestion?
See, I think, Lovisha, I think when people start saying something, that's anyways the last thing you should do. Whenever the decibel of silver goes up, that's when you don't touch silver. When NASDAQ went up, people only speak about Bitcoin. 2017, there was not even one person after 2017 who would not pull me up for why not recommended Bitcoin. Today, Bitcoin is at 5-year lows. Nobody seems to care. So point I'm trying to make is when the decibel of global investing, especially to risk reduction, if that's the hypothesis somebody is painting, then I think he or she is very far from mathematics. The standard deviation of Nifty is 6% lower than S&P 500 for the calendar year 26. This doesn't happen too often. So S&P 500, in spite of having 500 stocks, Nifty has 50 stocks. Nifty 50 has thrown 6% lower standard deviation than S&P 500. And I see some FII fund managers, especially Indian FII fund managers, saying that India is a risky market. I don't know what mathematical measure of risk. Is it value at risk, standard deviation, beta? When I ask them which risk measure, they don't have a risk measure on an Excel sheet to prove that India is more risky. India is a lot lesser volatile. One day after the war, Nasdaq fell 8%, 9%. That was our total fall during this whole movement from February and the war having broken out. So volatility is low in India. Consistency of earnings is significantly high in India. But if you're looking at quick money, global diversification can help. And I would definitely not vote for it at $95 per 95 rupees per dollar. I would not want to buy dollars and send money abroad. If you've not done that, you're anyways too late. If in India, if my model portfolio has delivered 15, 16% for the last 10 years, did I miss out not being in the globe? The answer is no.
Okay, got it. Feroze, like you mentioned that, when the entire herd has been saying something, then you should always follow a divergent path. So your outlook on gold and silver prices, they've been down 30 to 50% from record highs. How do you think investors should approach, gold and silver ETFs at the current juncture then?
See, I think if you go back to my very vocal call on gold at $4,800, there was no logic why gold would be at those levels. Of course, people can paint some logic saying that central governments will keep accumulating gold during war zones. This is the pitch everybody gave in January when gold was at 1,87,000 per 10 grams in India. That's why 24,000 crores came into ETFs in January, and ironically at the highest prices ever. Last month was the only month where we have had a negative flow or no flow in gold ETF when gold prices have come down to 1,42,000. Like you rightly said, Lovisha, when everybody's speaking about it is when you have to be cautious. If everybody's speaking about it and the past performance is good, if these two combos come, then you will have to sit back, reflect, and then take action. Most often than not, if these two come together, past performance and everybody speaking about it, if it comes together, that's a warning signal. So where do I see gold? Gold is, as we speak, at $41.39 an ounce. At 5,613 was the highest in January on 21st January, if I'm not wrong. So that's a 30% fall in dollar terms. In rupee terms, if you look at any ETF, it has fallen only 19.5%. Why has that happened? In rupee terms, we have not fallen so much. That's because government has been generous, or a short-term move of an import duty hike, and the dollar depreciation or the rupee depreciation has created some degree of cushion, is why Indian investors in gold have still enjoyed a little fillip than the global investors. Global investors, I was looking at an ETF from the peak, it has fallen about 28%, but the same corresponding ETF in India has fallen 19.52% as of yesterday from its peaks. This extra cushioning is because of import duty and this. So I would not be too bullish. If you want to invest some money in gold, especially only allocate debt money, but in a staggered fashion, not a one-time.
Okay, got it. All right, Feroze, wonderful conversation like always. But with that, we have to let you go. Thank you so much for joining us and, of course, appreciate your time.